So the American economy, the strongest economy in the world, could become as bad as Greece in the next few years? I mean, Greece is...
I don't know that it's the next few years, but I mean, we have, I don't think it could become as bad as Greece, but it become conditions that we've never experienced before. I mean, we have a lot of advantages. We have a huge resource base, but already this prolonged period of economic underperformance is beginning to adversely affect our demographics. Our family formation rate is coming off. The birth rate is declining. The number of people moving into the United States is dropping off. And part of the reason that our demographics are deteriorating is because people no longer see the economic opportunities. Yes, we have a lot of latent strengths that should prevent that. But nevertheless, if we pursue the wrong governmental policies, that's where we're headed. And I'm not saying that that's something that happens, in the next year or the next several years, but this is a process. It's a slow process, and we're on a very unsustainable and negative path.
Would it be fair to say that this could happen over the course of a generation, and that maybe the next generation might be the first in American history to not live as well as the generation that preceded it?
Well, I think that's true right now. I mean, if you look at the employment levels since the peak in 07 and 08, we've lost approximately 6 million jobs. We've lost jobs in every age group except the group that's 55 years of age or older. And the reason for that is that people that are in that group are not retiring, or they're coming back into the labor force, which is stunning the mobility. And so we have a lot of youngsters that are unemployed, are in colleges and universities hoping the situation. And so the latent problems are there. They're not very visible at the present time, but they're there.
Now, wouldn't cutting Social Security benefits actually increase the problem that you just spoke of, putting more seniors back into the workforce and exacerbating the problem of young people being unable to find work?
Well, yes. Yeah, there are going to be serious trade-offs. But if you can do these trade-offs, reform Social Security and Medicare, and hold the marginal tax rates or possibly lower them, eliminate the loopholes, cover some of the debt problems by consumption-based tax, eventually the economy will begin to recover. You'll free up resources for productive investment, but it will not occur quickly, and it will take time.
The policy in this country of late seems like it's been short-term gain for long-term pain. We can boost the economy a little bit now, maybe get our officials reelected and back in office for another term, and suffer the pain later. What it sounds like you're advocating is a little bit more short-term pain for a large long-term gain.
Yeah, and I think that's what the McKinsey data show, that they looked at 32 cases of extremely over-indebted economies where the over-indebtedness led to a financial crisis. They're all the documented cases since the 1930s. And in 24 cases out of 32, which would be 75%, it required austerity. And for the austerity is defined by McKinsey is a sustained rise in the saving rate. Some people think that, well, we could use inflation as a way out. Well, in McKinsey's database, the only cases where inflation solved the problem were very small emerging economies. And I don't think that would work in the U.S. for a variety of reasons. One of which is the fact that the debt to GDP ratio is so high. Interest expense at the federal level right in 2011 was 10% of revenues. If you make the assumption that the market interest rates hold through 2030, in other words, 2% 10-year note and comparable rate that they hold through 2030, which is a very unrealistic assumption, the interest expense rises to 20% of federal revenues by the end of this decade and 35% of revenues by 2030. By the end of this decade, The three largest components of the federal budget will be Social Security, Medicare, and interest. Now let's say that you get an inflationary process going. Interest rates will rise proportionally with inflation.
Of course.
Unless you want to make the assumption that investors on average lose money from a transaction, which they're not going to do. So if the inflation rate goes up 2 percentage points, then the bond yield and the interest cost will go up by 2%. That would add another $350 billion a year to the federal budget. Now, would rising inflation boost GDP? Would it rise as much, or would it rise more slowly than interest cost? Well, if you go into an inflationary situation, there will be some that will benefit. But what has happened historically in the United States and in numerous other cases, when inflation takes off, wages will not rise as rapidly.
So once again, our middle class is worse off. So if
and the GDP will not rise proportionally with the interest cost. So if you get into an inflationary situation, interest will become an increasing proportion of not only the budgets of the federal government, but the state and local governments, and you'll have to transfer funds from other operating expenditures into interest expense, which is the least productive type of spending. So basically, in my view, inflation is not the answer for the United States.
If we try to inflate our way out of this, we're going to end up spending more and more of our money on debt. We're going to end up hurting the middle class. So the way out of this is what?
That we're going to have to engage in austerity. We're going to need a program of shared sacrifice at the federal level, because the federal government is a critical element in the component. You're going to have to do the four things that I said. You're going to have to reform Social Security and Medicare. You're going to need to eliminate the tax loopholes so that taxpayers share in the sacrifice. You're going to have some modest consumption-based tax, and hopefully we protect the marginal tax rates. And if you cannot do that, then there's no path out, and that may be the path we take.
I mean, it sounds like a very reasonable plan to me. I guess we can only hope that our politicians will become reasonable. I'm not sure that's ever going to happen.
That's what concerns me. It's not that we don't know what to do. There are some very sound proposals that have been taken. For example, there was the Simpson-Bowles Commission appointed by President Obama. I didn't really agree with the bulk of the recommendations, but it was a comprehensive plan, and we're going to need a comprehensive plan that hopefully captures some of these elements. But unfortunately, the political will wasn't there even to try.
Wow. And so if the United States doesn't have the political will to try, yet we seem to be worse off than Europe, what does the situation look like in Europe for the next few years? What has to happen there to fix this?
Well, they're more chronic, in part because they've made promises that are greater, and their demographics are much worse. But I would not take a great deal of solace in the fact that their demographics are worse than ours, because ours are starting to deteriorate. And everybody points out, well, Japan has terrible demographics. Yes, they do. But their demographics today are not as bad as they were 20 years ago. In other words, when you get into these debt-induced periods of economic deterioration, one of the things that responds are the population parameters.
Interesting. I always hear of demographics cited as a cause for economic instability. They rarely hear it as an effect.
Yeah, it can be. Yeah, it can be.
That's very interesting. Now, we've talked a lot about the major Western economies and, of course, about Japan, but the elephant in the room these days is that one of the largest economies in the world continues to be China. They've been posting great GDP growth numbers for many years, but now there's talks about whether or not there's a bubble in China, whether or not China's GDP might come in at lower numbers. What does the situation look like in China? Are they as indebted as Western nations?
Well, we don't know the private debt totals in China. If you look at the official government debt in China, it's 16%, which looks really good since we're at over 100. However, 45% of the enterprises in China are owned by the government. And these enterprises have issued a lot of debt to build things. New railroads, new airports, new port facilities, cities that are vacant, facilities that are operating at virtually no capacity. And if you look at their hidden liabilities, their government debt is about 165% of GDP versus our gross government debt of about 100. The studies have shown that once gross government debt moves above 90%, bad things start to happen. That economic growth begins to slow, and materially so. And you can produce economic instability. In China's case, I think that the risk is quite great because this big expansion in debt pushed investment spending to 70% of GDP. Consumer spending is only 30. In the United States, consumer spending is 70 and investment is 16. To have a investment spending to consumer spending of 70 to 30 is not sustainable.
Well, why is that not sustainable? Isn't building infrastructure, isn't building schools and highways and ports really something that helps stimulate the economy?
It does help. In the short term, it's very helpful. But then you have to maintain it. And the banks made the loans, and the loans are not being repaid. And the interest is not being repaid. And so what we're getting closer to is a point in time in which the Chinese government will have to take funds from its operating budget and move them to recapitalization of the banks. And that's what happened in the mid-1990s.
Yeah, haven't we seen this story
Yes, we
before?
have.
Wasn't China the cause of the original economic crisis in Asia?
That's right. And it all stemmed from the fact that they had to take operating expenditures and shift it to the banks to recapitalize them. It produced the Asian economic crisis, affected Russia, even brought down one of our big hedge funds in 1998, long-term capital management. So China may be more unstable. And in fact, I think the Politburo in China is very badly split. It's not as cohesive. There are tensions. And I think that there is a what you might call the old guard and the new guard, for better or lack of another term. But the new guard knows that they're going to have to respond to this imbalance. And the old guard thinks that they can continue doing what they've always done. And I think the new guard is right, and it looks like that there are many inside of China know that they are in a potentially unstable course. One final point. The IMF produced a study published earlier this year, and it was given wide circulation. It was on the front page of the Wall Street Journal. It was called China 2030. And in this report, in which the Chinese participated, there was enough dissent inside of China that they agreed with the conclusion that China's economy could experience extreme downside volatility. It's inherently volatile, and it could erupt at any time. And I think that's the risk.
So China has just as much, if not more, potential energy for a major crash coming as Europe and the U.S.
I think they do. I think they do. And I also think that the lesson of history may be against them too.
Now, one of the major economic booms of the last few years, despite all of the problems we've seen in U.S. and European economies, has been natural resources. Gas prices are up, oil prices are up, gold prices, silver prices. And China is a major consumer of most industrial metals in the world, a major importer of oil. Would a major disruption to the Chinese economy cause problems in the resource markets?
I think it would for the industrial commodities and the industrial fibers and things like that. I think gold and silver is a different matter because I think in periods of economic instability, gold and silver will hold their value or even appreciate.
So we've seen a serious correction in gold in the last few months. Does that mean that today you think gold is a good investment?
Well, I'm really not in a position to say. I'm in the fixed income markets, and so I'm not a professional here. But I will just say as a personal matter, I make investments in gold and silver coins, and I'm going to continue to do that. I hope that helps you. That's as explicit as I can get.
I think a number of us hold gold and silver coins. It's sort of the insurance policy against all other money falling apart, isn't it?
It is, yeah.
So it's good to have something that is not, at
That's
some
correct.
level, someone else's liability, which
Yes.
all other money in the world is.
But I can't give you this as a professional. I'm not a student of, this is not where I make my money, but I think that there is value, and I think it should be in someone's portfolio.
And you do make your money in the bond markets. And what is the outlook these days for the bond markets? Do you see major rise in the interest rates coming, major problems with bonds, or are we going to continue to see this low interest rate policy for a long time?
I think we are going to see the low interest rate policy, and I think that we may, over the next couple of years, 2 to 5 years, go even lower in terms of long-term rates. The long treasuries went to 2% for 10 or 15 years in the late 19th century after the buildup of railroad debt, other in the 1860s and 1870s. On the eve of World War II, 1941, long treasuries averaged 2.1%. Now, this is the long treasury, this is not the 10-year. And it was trending lower, which was 12 years after the panic year of 1929. The Japanese rates, when their panic year occurred in 1989, the JGBs were at 5.6, they're at 1% today. So the interest rates are a measure of economic activity. Many people don't think of them that way, but they are. If times are good, business conditions are good and robust, and there's legitimate demand for money, interest rates will be high. If conditions are not good, interest rates will be low. And I think that one of the side attributes of an over-indebted situation and a shift of the borrowing to more and more unproductive uses is that it makes the economy weaker, and it produces the effect of lower interest rates.
But if the American economy is struggling so bad and the American government continues to go into deeper and deeper debt, won't the people who buy our treasuries, who buy our government debt, eventually start to demand higher interest rates in the near term?
There will be that point. That's what we call the bang point. Dr. John Cochran at the University of Chicago, one of our leading macroeconomists, former president of the American Finance Association, one of the leading researchers, he says, think about an asset. And how do you value an asset? Well, you look at the income stream from that asset and you discount it by some appropriate interest rate. And that gives you net present value. Well, what is the net present value of a treasury bond or treasury security? Well, Dr. Cochran makes the point that it is the discounted value of future government surpluses, which would be government revenues minus government spending. If you hit the point where in the investment markets no longer have confidence in that stream of future revenues, then the discount rate will rise. And monetary policy won't be able to control it, and fiscal policy won't be able to control it.
So as we've seen in Greece, as we've seen
Absolutely.
in Italy, as we're seeing
Yeah.
in Spain today,
Yeah.
it may take time for that confidence
That's
to be
correct.
lost.
That is exactly the point. And that's the path that we're on. In other words, if we do not control the deficit spending, we will hit the Cochrane constraint or Reinhardt and Rogoff's bang point. And once that happens, our monetary and fiscal policies will really not work for us, and we'll lose control of the interest rate. And it's tricky knowing when that happens. I've looked at modern cases, historical cases, and frankly, when the bang point occurs is not that clear. Suddenly you can be going along, everything can seemingly be quite healthy, and then it begins to deteriorate. The deterioration can take place relatively quickly. I think maybe Japan is now slightly turning the corner. And I don't think that they're going to be in serious trouble, but as the debt levels are getting above 500% of GDP and an interest expense is taking up more than half of their federal budget, we're beginning to start to see a fall in the value of the yen.
So Japan's now at a point where more than half of all the tax dollars that come in are going to just service their debt?
That's correct.
That seems like
that at very low interest rates. And if the interest rates were to start rising because of the lack of confidence in the Japanese to repay, now they have a very much more regimented financial market situation, but regimented financial market situations ultimately break down. And I mean, I don't want to mislead you here, because economic theory has never dealt with this issue or determined at what point the bang point occurs, or the Cochrane constraint. This is something that has not been identified by economic theory. If you look at some of the examples, you get a wide range of experiences. It depends on a whole host of other considerations. Some of them occurred in wartime situations or semi-wartime situations, or it seems to make a difference whether countries are politically cohesive or uncohesive, the general wealth of the country. But so we don't know exactly when, but one of the things that seems to start happening that's an early warning sign is that the currency begins to depreciate. Now, right now, we're on a bad path. We're heavily indebted, but the Europeans are more indebted. The Japanese are more indebted. And so the dollar is getting a bid, not because of anything inherently good that we're doing, but because the situation is worse in a lot of other critical areas.
So the irony is effectively we're the least bankrupt family on the block.
That's correct, right now.
Wow, wow. And it sounds like, if there is no rule of thumb for when these things happen, and it sounds like we're not just playing a game of chicken with this massive debt, but they're effectively playing a game of chicken wearing a blindfold. And we
That's
have no
correct.
idea.
That's correct. We don't know. We don't know.
Yet your plan seems so reasonable. We can only hope that politicians and more Americans listen to what you have to say, and we take the.
It may be reasonable for you and me to sit here and talk about it, but confronting the political will is an entirely different matter.
A monumental challenge, to say the least. Well, thank you very much, Lacy.
My pleasure.
Appreciate
Great
it.
interview. Thank you.